Hi, everyone. Thank you for joining us today. On behalf of Reuters Events, I'd like to welcome our two wonderful speakers, Sternberg, CEO at Lake Hill, and Yung-Shin, CIO and Head of Quantitative Investment Strategies at Credit Suisse. I don't want to take up too much of your time, but I hope you enjoy the conversation, and I hope everybody's well. Thank you very much.
Good afternoon, everyone. This is Zem. So Yung-Shin and I will have a sort of free-form conversation on a variety of topics. The three primary questions that everyone seems to be interested in and have been reaching out to both of us are what's working, what's not working, and why. And the second question is related to that, which is what are the implications of the current COVID, for lack of a better name, current COVID market, and how is that impacting your business or your strategy? And then the third question is, what are the opportunities for Convexity today, both long and short? Yung-Shin will take a stab at it first, and then I'll follow up after him.
Super. Thanks, Sam, and good afternoon, everyone. So what worked, what didn't, and why? To some extent, I think the biggest surprise for the first half of the year was the lack of surprises in strategy performance, given what happened in the markets. I think most of the tools available to investors to mitigate cyclical growth risk worked broadly as expected. So we came into the year with the 10-year bond at 1.9% or so. A lot of people were concerned that bonds may not provide much insulation against an equity sell-off. But in fact, bonds appreciated about 8% from January to March. Our own Credit Suisse Lab Managed Futures Index was up over 11% from its low point to its high point in March. And the Dow Jones US Market Neutral Equity Quality Factor Index was up 15% over a similar time frame. So what worked was portfolio balance and diversification. I think interestingly, many alpha strategies didn't work. We published the Credit Suisse Hedge Fund Index, which was down roughly 7% in March, and which remains down more than 3% year to date through June, which is fairly in line with the S&P 500 for the first half. So I guess sort of the interesting dimension to the question is why, what are the lessons learned? And I think it sort of boils down to two issues. The first issue is systemic risk. Many dimensions of alpha generation, we think about alpha generation really along three lines. Edge in terms of accessing opportunities, edge in terms of execution efficiency, and the ability to time. And all of these things, to one extent or another, are somewhat impacted by systemic risk as counterparties retrench, as market liquidity wanes. We put out a research piece about a month ago that talks about this, and I'm certainly happy to share that if that's of interest to anybody. But I think that does highlight the extent to which systemic risk does in fact infect a certain spectrum, certainly not all, but a spectrum of alpha strategies. I think the second element of why boils down to forecasting. We run a number of macro models which indicated a meaningful shift in market conditions over the course of January and into February, which changed our performance and risk forecasts. And I think this contrasts with the tendency to chase returns if one considers something like a naive risk parity approach. There was a pretty substantial run up in markets from October to mid-February with the S&P 500 up relatively, roughly 15%. And so anybody who was heavily linked to the level of delivered volatility or chasing those returns had fairly significantly bad experiences coming into the more difficult period of March. So I think differences in forecasting really explain sort of differences between successful outcomes and less successful outcomes over the first half. The second question is, what are the implications of COVID on our markets and business? I think the temptation here is to frame the question as one in terms of sort of a deviation from normal, which we're presumably in, And then, when are we going to normalize, and how is normalization going to take place? And also to sort of draw this dichotomy between, what's happening within our businesses operationally on the one hand, and sort of what is the market opportunity on the other hand. And I don't really think that sort of a dichotomy or approach is necessarily appropriate. I think COVID, this episode, what we're dealing with, started out really as an exogenous shock, sort of an unknown type of shock, which people are grappling with, trying to understand the implications to. It's now really an endogenous risk in our minds. It's something which is sort of embedded, implicit in the system, which the system is trying to adapt to. The spread of the disease at this point is a function of behavior, and to an extent, if there's a response in terms of a vaccine, the ability to develop that type of response. So it's less these days about COVID happening to us. It's more about us as society, as civilization, happening to COVID, which is a very different dynamic. And I think there are, really two primary implications of this situation to our business. The first is a set of structural themes, which was already underway, is gaining steam. The World Health Organization director, Tedros, was quoted on Bloomberg on Monday as saying, there will be no return to the old normal for the foreseeable future. And I think he was probably more right than I think even he suspected. COVID is catalyzing the adoption of telecommuting. It's accelerating virtual reality, augmented reality. It's accelerating esports. We spent a lot of time analyzing these dynamics and incorporating them systematically in our portfolios and in our workplace, which shows that there's a great deal of connectivity between these. I mean, this event is a great example of the extent to which the nature of business is changing in ways that I doubt we're going to completely revert from in the future. So there's a lot of structural shift which is being catalyzed as a function of this environment, and there will not be a normalization per se, and that creates a set of opportunities. The second dimension to the implications for our business is that I think known uncertainty has increased. I'm sure Zem will speak at much greater length and detail, but looking at the VIX as an example, it's still, last time I looked yesterday, it was still close to 30. We apply macroeconomic models to assess current market conditions, and they paint a consistent picture. Since the beginning of April, we've been in a headline-driven, non-committal market environment that we would broadly describe as, in our language, as sort of transitory, one where there's a low degree of conviction and a high likelihood that we either move back into more of an expansionary environment, or that we revert back into what was, according to our models, more of a contractionary environment in March and April. And that implies, from our perspective, that as we're forecasting the potential for investment strategies, there's a wide, the outcome space is quite broad. There's a wide range of potential outcomes, which ultimately, as one puts together a portfolio, needs to be balanced. That said, I think we have learned a tremendous amount around the efficacy of a lot of the plans that were put in place post GFC. The regulatory environment has been one which has required a great deal of planning with an emphasis on sort of business continuity and management. And I think it's been surprising to all of us that through this environment, working remotely has been as seamless as it has. So I think a lot of the things that were put in place in advance of this episode have worked, and this episode, to a broad extent, is catalyzing change, which was already underway, but sort of acting as a means of accelerating it. The last question is where are opportunities in convexity today, both long and short? And I'm gonna avoid talking about just convex instruments. I think philosophically, we think that there are opportunities to manage convexity, both through top-down decision making, so allocation policy, as well as bottom-up decisions, so security selection. And actually, asset allocation to us may be the lower hanging fruit, in that managing negative convexity is often less expensive than going out and outright buying convexity. So we've been working with a lot of investors to understand how the risk breadth, how many distinct bets, if you will, they have in their portfolios evolves through time. Underpinning this notion is that diversification is not a static concept, it's really a dynamic concept. And so we want to ensure with our partners, our clients, that we're not allowing their portfolios to allow inefficiencies to creep in by way of latent risk concentrations, where distinct allocations unexpectedly overlap in their risk profile. As we all know, correlations differ on the upside versus the downside, and it's the underestimation of downside correlation that often gives rise to negative convexity and negative skew at the portfolio level. And so the management of the correlation structure between the upside and the downside is something which is a fairly obvious, not necessarily simple, but obvious means of trying to manage some of the negative convexity that typically comes into portfolios because of misspecification of correlation as people think about putting portfolios together. The other element is security selection. There are a number of strategies that we think of as generally convex. I think probably the most classic example is price momentum strategies like trend following, which have historically offered very good convexity, especially on the downside. And I think that likely holds today. We've seen, a massive reversal in many parts of the market over the course of the first half. And so many of these strategies are relatively neutrally positioned, often operating at the lower end of their volatility targets and sort of exposure bands, which means that they will likely react pretty quickly if we end up accelerating either to the upside or to the downside to position accordingly and magnify that positioning. I think we have the potential for very positive outcomes. If we have clarity around the election in the U.S., for example, if a vaccine does end up being efficacious, given the magnitude of stimulus that is supporting the markets, or potentially very negative. There's obviously demonstrations of social unrest in a number of different places. I think the U.S. has been very visible from that perspective. There's clearly the chance for continued mutation in this virus. There's been resurgence in places. We don't know what the fall holds for the Northern Hemisphere. And clearly the nature of economic contraction against which this policy mix has been spent is enormous. If one looks clearly, or more simply, at shipping volumes, for example, there's been a meaningful double-digit decline, which we haven't reverted from. And so the real economy clearly is in a position in many segments which is still quite stalled. So I think there's certainly significant upside risk. There's also significant downside risk. And trend following offers a means of having some level of convexity to that sort of a dynamic. The nice thing about the strategies as well is that they are strategies which support relatively high target volatilities, which allows them to be utilized by investors in things like portfolio overlays. So we think convexity is really important, obviously very topical. We think that there are a number of different levers at investors' disposal to try to manage the convexity problem. So let me leave it there. Zem, over to you.
Beautiful. Thanks, Yung-Shin. I wrote down, you brought up some good points. I made some notes, and I have some questions for you on the flip side. But so just to reiterate, the three primary questions that we talked about can really be summarized as one primary question, which is what's working, what's not working, and why. As from our perspective, Lake Hill is an investment manager with an extreme focus on broad-based index options and futures, things like the S&P 500 or the Russell 2000 options and futures. And the thing is about these products is that many strategies from credit to distress to long short to CTAs to stat arb to even private equity or real estate, they all monitor and trade these products to hedge and transfer risk. They may buy options, they may sell options, they may buy put spreads or call spreads and so forth and so on. And we actively trade these products in an automated, disciplined, focused manner in order to hopefully earn the natural edge that is created by all this trading activity. We basically seek to profit from the well-known difference between what an option costs and what it pays off over time. Now, clearly, the markets have been very volatile and the opportunity set is very high, but so are the risks, right? The risks are high, the opportunity set's high, VIX is high. But before I even go into that, there's something that's going on in our industry which is causing big, big problems. And the problem is that with all this activity and all the people who are clicking on their screen or trading these products, they end up losing money over time. And we've seen this over and over and over. Whether you are buying options to hedge your portfolio, invariably the hedge doesn't really pan out, or you're selling options to earn some yield, you end up losing a whole bunch of money, which is far more than the yield you thought you'd make. And it's only getting worse. And the thing is, the troubling aspect of this is that these products have been around for a long time, and now is when people need them. Now is when people need to use them to hedge, transfer risk, add yield. And yet, this problem of this inability to actually monetize what's going on in there is not going away. And as volumes are booming, it seems to be getting worse and worse. Now, you might think that the solution for that is, okay, let's get a better forecast for volatility. Let's get a better pricing model. Let's get a better supercomputer. Let's price options down to 20 decimal places. Let's get free commissions. Let's try to do all these different things. But that's not what actually solves this problem. In order to actually trade these things successfully, you need to have a very disciplined, automated, computerized process in order to make money in these markets sort of with a positive drift. We've all seen the guy who's made money one time, talks about it the whole time, and then just is not able to repeat it. We've all seen the guy who markets how well their tail hedge did, but then you don't hear from them as the markets rally back. So for us, whatever the strategy, whatever the focus, the key to success is to deploy some very advanced technology, implement it in a very disciplined process to harvest this known edge over time. And the reality is most investors are just unable to do it. It's not a question of skill set, they're just unable to do it because that's not their focus. Right now, the opportunity set, to give you an example, a very specific opportunity set is, because of all this activity and because of all this heightened volatility, for us, is to actually own downside options, which is very counterintuitive. So whether you are targeting long convexity, short convexity, relative value convexity, we see opportunities in owning downside optionalities. In fact, just to give you an example, we were a buyer of downside puts at the peak panic with the VIX at 70 and the market way lower. We continued to buy them with the VIX at 60, 50, 40, 30, and the market rallying. And the net P&L for all this activity on our part was slightly positive because of our process and our hedging activity. We also see specific opportunities for convexity today to sell it. I mean, clearly the VIX is elevated. There's an opportunity to sell it, mostly on the at-the-money near-term expirations on the S&P 500. There's also an opportunity to do relative value trades where we're short the front month, long the back months. Ultimately, all these different trades won't work unless you have a process for every day to re-hedge it, recalibrate it, re-optimize it, and reinvest in it so that at least that process can work over time. Another sort of very interesting metric that we're seeing, people have asked us, what's changed? What's changed in the market? We all see the same headlines. We all see the same stuff about COVID and the Fed spraying money all over the place. We all see that the VIX is fairly elevated. And people ask me, why is that? And when will that potentially return? It's not clear to me that the VIX will ever return to something that we call normal. And what I mean by that is, I don't think we're ever going to see VIX at 7 or 8 or 9, which is what we saw in 2017. And the biggest reason is most of the natural sellers, or many of the natural sellers of volatility, have basically disappeared. Most of the structured products that come out of Asia that eventually hit our markets in the US have basically disappeared. A lot of the writing programs, their AUM is way down. And so clearly the VIX is sort of fairly or reasonably priced at the sort of 25 to 35 range. And we're probably going to see that. I mean, I don't have any big bets on where the market's going. We don't know, we can't predict it, but we think the risks are elevated, and they're elevated for a reason, structural reasons, not just the headlines. The opportunity set is fairly significant, both to buy it and to sell it. But the reality is to make money off of actually trading it, you need a process. There's no magic formula here other than the magical process. And that's sort of the main focus and the way I would answer the three questions of what's working, what's not working, what's changed. To a certain extent, someone keeps asking me this question, what's working today? And to a certain extent, the broad answer to that is the same thing that worked today is the same thing that worked a year ago, 5 years ago, or 10 years ago, or 20 years ago. And that is to have a disciplined process in place. So with that, I'll turn this back to Yung-Shin or ourselves to ask each other questions, unless Yung-Shin, you had a question for me, and then I can ask you some questions, and then we can open it up to the participants.
I'm gonna see how tough your questions are. Why don't you go first, Zem?
You said that diversification is not a static concept. And I was curious about what you meant by that. Because, let me ask you that, and then I have a follow-up question. I feel like I'm interviewing him. I have one question with a follow-up question. Go ahead.
That was good. So I think the way that one should, we're actually in the process of trying to get something like this on the slide, because I think it's a hard concept to necessarily explain. If you think about a probability cone, they seem to be increasingly popular these days, and assume that the probability cone for, looking out, just take the S&P 500, where's the S&P 500 likely to be over the course of the next month? And if we think that the breadth of the probability cone around the S&P 500 over the next month has changed, that there is, different weights around different levels, percentage-wise versus where we are today versus at the money today, then implicitly that, you're talking about a distributional shift. And so if that distribution is shifted, that has bearing on its relative attractiveness to the other components of a portfolio. And so the notion, if you want to think about assets as having different forward-looking distributions of returns, and then portfolio construction is sort of the commingling, the blending of these distributions, then shifts in each of the respective distributions have implications for how you want to sort of manage the totality. And so, to be diverse, to be efficient, one has to account for the dynamic nature of what we expect. One of the lenses that we look at engaging that is sort of the state of current market conditions and what that implies about the likely evolution of markets over our forecast horizon. And so we're really getting at this notion that, if we were sitting today, January 1st, COVID wasn't an issue. Markets were broadly in a healthy sort of, expansionary growth begets growth type of phase. Expectations for a range of strategies and assets are quite different than they are in an environment where, the predominant sort of characterization of the present, as I mentioned, from our standpoint, is transitory. We're beginning to see more of an inkling of this expansionary dynamic coming into play, but the predominant sort of nowcast, if you will, of current conditions is one of being sort of in flux. And that has very different implications about the likely path of investment strategies and assets. And so the blend should reflect that likely path into the future. And so that's the notion of a dynamic view of what diversification means. It evolves through time with market dynamics.
That's very interesting. It sounds like, if I could summarize what you're saying, is that the amount that you allocate for your diversification strategies changes as the risk reward changes. Would that be sort of a summary of how do we do it? We look at this a little bit differently. There are clearly, diversification is great and you should do it. But at the end of the day, and we all know this, diversification doesn't guarantee against drawdowns and losses, obviously. And typically people will diversify into things that they think will perform well when the market goes down. But there's no guarantee that it will perform well when the market goes down. I mean, you run a whole cluster of strategies, but there's a certain set, their odds might be slightly in your favor, but the best way to perform well when the market goes down is to just be short when the market goes down. But of course you can't time the market when the market goes down. Or another most direct, practical, direct way to deal with the market going down is to have some sort of hedge or left tail or something that will kick in when the market goes down. And the most direct way to do that is to deal with self-serving, the S&P 500 options and futures market. The problem is that most people who have tried that have bled to death. And so what they need is some sort of process. Anyone can buy, for example, a 1/3 ratio put spread. That's where you buy 3 puts and you hedge it and you fund that a little bit by selling 1 put and claim to have a hedge on. And that could work and it would work, but then they end up selling it too soon, or they don't sell it at all. And then it goes to some big number, then it expires. And so that's why I was interested in your diversification, not static, is that one way of helping people deal with these ridiculous drawdowns, which can occur if you're exposed to the equity market, is to just go directly to hedge. And yet, as I pointed to earlier when I was speaking, is that it's easy to actually click on a screen and say that you're hedged. It's not so easy to actually do it in a manner which has a positive drift and a positive payoff, and then actually you keep the payoff when the event occurs. So our approach is you should have your diversified portfolio, do what you're doing, take a little bit and allocate it to something which is directly hedging your downside, and maybe it just performs, a small positive drift in other environments. That was my question and comment and commentary to you. What about you to me?
Yeah, I think let me briefly make one statement about that, and then I think there's an maybe interesting question I have for you. So in our minds, diversification is the core notion is one of, we're all living with uncertainty. If we had certitude around what the future holds, then we just buy the winning asset. It's very simple. What we all have to deal with is the fact that we don't have total clarity on what is going to happen. And so the notion of diversification is the management of that uncertainty in an optimal way. And so what we're really trying to do is say that the nature of uncertainty is shifting. And so the way that you deal with that uncertainty is shifting accordingly, which I think is should be fairly intuitive and sensible. I would agree wholeheartedly with you that if you wanted to hedge a particular type of exposure, you're most likely going to find the right hedge, the right convexity around that hedge in that asset class with somebody who knows the idiosyncrasies of that particular asset class. And I think, if I'm not mistaken, we don't traffic in the same space, so I don't know your market all that well, but I think there was some suggestion of some of the challenges of structured products that exist in the sort of retail space and the bearing of structured products on sort of how the implied vol space trades generally. And I guess the question I had, a lot of this historically, at least from a tourist perspective, is allegedly due to Asian retail, Japanese retail, because Japan was sort of at the forefront of the low rates phenomenon and the need for increasing yield for people who otherwise couldn't get yield. How, in light of what we've seen in both the front end and longer term interest rates, how does that impact your view on, what's your expectation for the correlation between the level of rates and the level of VIX?
Our focus is on coming up. We don't know where rates are going. We don't know where VIX is going. We don't know anyone who actually can predict any one of those things with any sort of accuracy or consistency. And so if the VIX is hovering around 30, and by the way, the VIX is derived from the S&P 500 options, which is something that we're very active in, then we'll be buying and selling somewhere around 30. We don't buy, we could be long convexity, short convexity. We don't really traffic too much, to use your term, in absolute levels. We're sort of more of a relative value approach. So we don't know. But what we do know, and something that I think we're reasonably good at, is calibrating the odds. And those odds change every day, right? So if the VIX is 70, there's a certain set of odds where we're willing to buy and sell. If the VIX is at 30, there are a certain set of odds where we're willing to buy and sell. But we try not to predict absolute levels. I think as you mentioned, and I'll repeat, from a microstructure standpoint or from a market structure standpoint, it seems like I'm not, for all I know, VIX could collapse tomorrow or could rally tomorrow, but it does seem like the natural sellers who I think inordinately suppressed volatility back in 2017 or 18 are gone. And I'm not so sure what it'll take to bring them back. So it seems to me there's all sorts of reasons that one could say, oh, the news, the election, the structure. But it seems to me if you want to sell premium to earn income, there's an opportunity to do that, particularly say in the, I would say the front near-term straddles. That's where you sell calls and puts. So they're very expensive. Think about that. They're trading at somewhere at I don't know, $200 or something like that. Think about that. They were trading probably $50 a year ago. And there's, if you want to buy Convexity, there's an opportunity, like I said, mentioned earlier, to do ratio spreads and ratio time spreads. And I think those are probably the best opportunities today without having to predict where the market might go tomorrow. Now, one key thing about this business, our business in particular, is when we say there's an opportunity, that means the odds might be favorable, which means you have to do this trade over and over again, repeatedly. And I think that trips up a lot of people as well, in the sense that they don't realize, oh, things cheap. It's cheap in an odds way. And an odds way means you have to do it again and again, and that means you have to have a certain time budget to let the process, to let the law of large numbers run to your benefit. That's sort of a long answer to your question.
I like that you came back to the notion of process, and I think one of the commonalities, in spite of the differences across strategies, is a strong belief we both have that it's necessary to have a disciplined process and to stick to that process. Maybe it's a good time to turn it back to Mark for any potential questions out there.
Mark's gone. He put himself on mute and he disappeared.
I'm here.
Mark, we would like to potentially open this up to some questions.
I'm seeing one here. Can you see the question and answer?
Yeah, all right, I see a question.
Perfect.
The question, if everyone can see it, is what would cause the VIX to return to historically typical levels? And how would that impact your investment strategies? And that there's a lot of crowding right now in the distressed credit space. Is there similar crowding in quant strategies or vol strategies? The 2008 financial crisis had a large behavioral impact on investors. How do you think that behavior will change after 2020? I guess since the question's on VIX, I'll answer it first. I mean, the natural answer is there'd have to be more sellers than buyers to cause the VIX prices to go down. There maybe have to more sellers of options to cause this thing to go down. Something that's very interesting is like everyone's calling saying, what's the opportunity today? You know, with all the government shutdown and the Fed, and everyone seems to be saying, oh, well, let's look at distressed and credit. But if you actually look at distressed and credit, or the high yield index, and overlay that onto the VIX, the graphs look very similar. And so we don't really see, if someone wants to get involved in distressed or credit today, they might as well just get involved. Like if you buy a credit fund, you're getting some high yields because some of these firms might go out of business. You might as well just sell an out of the money put on the S&P and get the sort of the same type of returns. So for us, they're all linked. And I think I'm not a credit expert, but we do see the link relative to the VIX. And so we think there's a better opportunity. It's a little bit self-serving that if you want to take on that type of risk, you're better off selling some sort of out of the money put spread on the S&P or on the Russell or on the NASDAQ to get a similar type of exposure while staying focused on a listed market. That would be my answer. Yung-Shin, if you have an answer to that question.
Yeah, I tend to agree. I don't have a strong answer to what would cause the VIX to return. I think one of the interesting points that's come up over this period is the speed with which policymakers responded to the financial markets. If we were to roll the clock back 20 years, I think policymakers would typically wait to see, the demonstration of damage to the real economy before taking action to try to resuscitate through the financial markets. Now, I think it seems like the tolerance for, any sort of a drawdown in sort of your central set of risk assets is something which there's a very low threshold pain in. And so I think both credit and equities have, they certainly do reflect similar dynamics in terms of sentiment, tolerance for risk. And I think both of them are also fairly central, one would expect, in terms of their linkage to the policy response, especially with certain credit instruments now outright, increasingly outright, being participated in by agents of government. So I think one of the questions is where does the border lie between the set of instruments that is within policy scope and those that are impacted by the policy scope. I think that so long as policy is efficacious, we would expect over time to see some level of normalization subject to the supply and demand points that Zem you brought up. I think this overall dynamic is one which investors are going to the rapidity and the speed with which things in the financial markets, at least at the index level, have normalized, I think is something which will also be remembered. I don't know if people are going to remember how painful March is, more how quickly the rebound was, and sort of that impulse to try to reinvest on any dip possible. I think that's probably one of the lasting dynamics that we'll see in the aftermath of this. Maybe I'll leave it there.
Yeah.
We have a couple of questions.
Yeah, it looks like a couple other questions, but because of COVID, how much time will it take the equity markets to revive? Not sure what that means. And then, another question, should you invest in T-bills at zero or taking risk in the equity markets? I mean, that's a decision that every individual has to make those are the two questions that came up. And those are an individual, you have to decide where you want to park your money. If you want to get zero, you'll get zero, but you'll get your money back guaranteed. And if you put it into a business that can go up or down, that's a different question. We don't know. I don't know what's better. I do know historically that investing in equities seems to do better over time, but we don't know for sure. One thing that we can look at to help guide us for what's going on now in the equity markets, we tend to be very analytical and data driven, is to look back at history. And while the exact reasons why the market goes up and down might differ, it could be due to COVID, it could be due to a terrorist attack, it could be due to over leverage in the real estate markets. We don't know the reasons why it might go up and down, but we can see when it does go up and down what happens. And I think the most pressing parallel today that we've seen in history, again, different environment, but what seems similar, is probably the 1930s. During the 1930s, again, different, but what I mean by this is the market moving, the market movements, the up or down 10%, the extreme volatility that we saw then is something that we're living through now. Something to remind everyone is that currently the market's pricing in that a little under 2% a day move is noise. That's pretty big, meaning plus or minus 2%, you would expect the market to move up and down a little bit, or how much every day is just out of noise. Well, the market's pricing in things around 2%, a little bit less, plus or minus, which means that has to be a risk that you have to calibrate to. And is it going to go up a lot? It could. Is it going to go down a lot? It could. You just have to manage your risk appropriately to deal with that type of variability and uncertainty. That's the way I would answer those questions. Yung-Shin, I had a question a little bit more specific to you. Is like, you're running a quant business, which sounds, which means you're probably very systematic and you're very disciplined and you're computerized. At what point do you think your quant models should be overridden, or do you override them?
I think it's I don't, the word override is probably a word which I don't necessarily think is sort of appropriate. We certainly think that everything that we do should be evaluated continuously. The set of assumptions that we're making explicitly and implicitly should be reviewed continuously. We typically sit down with the key decision makers within my area, multiple times a week to go through what we're seeing assumption wise and sort of how things may have changed that may impact those assumptions. I think an easy example to make this a little bit less abstract is, if we look at what happened in WTI oil in the U.S. In March and April, and we saw, some very strange dynamics around delivery where prices actually went negative in certain contracts. That's something which a lot of models may not have been built to be able to accept. And so if that becomes known as a possibility, fortunately, really didn't impact us, but I think conceptually, if this becomes known as a possibility, and you have a set of models or a program which doesn't accept it as a possibility, then that's something that you should change. And you should always be open to the possibility that circumstances change. Now, I think that there's a bit of a view which we think is an oversimplification, which is that quant techniques are naturally quite myopic in nature. They tend to be very focused on something and miss the big picture. And it's sort of by extension this notion that you're sort of driving through the rearview mirror, whereas more discretionary approaches may be more forward-looking by design and sort of in their nature. The reality we think is that all investors are driving through experience through the rearview mirror. The question is sort of the application of what set of history, what set of experience do you apply in determining what the future is likely to give you. What do you use to determine what set of probabilities are appropriate in making a investment decision. And so that sampling of history is something which can be oversimplified, and we think that's a risk of many quant techniques. It can also be overcomplicated, and there's also the potential to introduce a lot of overfitting in design of various systematic strategies. But I think the consciousness of the fact that all investment strategies are using experience to make decisions is important, and the notion that the problem that all investors have is the application of the right set of experience. I think the acknowledgement of that is what ensures that doesn't become a problem. And so we try to be very aware of where we want to introduce a higher dose of reality as opposed to simplification, and where ultimately things are appropriately modeled and simplified. And we don't think there's any difference, quite frankly, at the end of the day, between the discretionary approach and a more sort of systematic process-based approach. And actually, the questions that were just asked, I think, sort of speak to this. I think to answer any question, one needs a framework of one sort or another, and those frameworks can change. But I think a framework is very helpful in answering a question. And so, systematic strategies tend to rely upon well-defined, well-understood, deliberated frameworks as opposed to less, fixed frameworks. So if you sort of look at equity prices and expectations for equity prices, in general, we sort of see opportunities arising from either the level of prices or the structure of markets. And if we think about, where should you be, equities versus interest rates, you sort of look at it from, if you look at it from a price dynamic, so forget about how markets function, but think about purely prices, there are two ways in which, you're going to make a return here. One is assuming markets are efficient, nothing changes, current prevailing prices, reflect all there is and are fair, in which case you should focus on how much, yield you get you can call it carry, if you will, making that assumption. And what you would see is, at least you'll have some return. There's an equity risk premium, but at least you'll also get some sort of return in sort of current dividend expectations with equities. If you're getting nothing for fixed income, then from a pure efficient market viewpoint, you should clearly own equities. The reason why that might not be the case is that there is a different appraisal metric which you would bring to the table, where you would express a view that the market price is actually inefficient, and your appraisal metric, whatever that might be, is a more appropriate means of valuing stocks versus bonds. And then that there could be a view that, hey, stocks are rich versus my appraisal metric, and there should be a sell-off in stocks, in which case you probably want to protect you have to park your money somewhere, so you probably want to be in something which is less susceptible to that drawdown. But there's a framework here which allows you to sort of decompose that problem along a range of dimensions, and ultimately that's the ambition of quantitative strategies, is to have very explicit assumptions which are realistic, and then apply those assumptions in a disciplined and logical manner to the resolution of these sorts of questions. So a loaded question in terms of when to override. I don't you should constantly be considering the assumptions and refining specifications, and I don't think it should be as binary, black and white, as override or not override.
Yeah. So it's basically what you're saying is you will update your approach, you will update your models, but you won't walk in every day and just suddenly say, hey, it's as if you were running a restaurant and someone didn't order chicken the night before. You say, that's it, we're no longer going to sell chicken. You're going to sort of look at it in an educated way, update it to the extent in as educated, disciplined, scientific way that you can, and keep moving. That's a great answer.
Yeah, you share that view? I'm curious what your thoughts are.
Well, yeah, I mean, we look. I can tell you what doesn't work. I can tell you what doesn't work. What doesn't work, and most people will agree with us. What doesn't work is trading off the news or off of your emotion. It just doesn't. I don't see what your edge or what your advantage or what your focus or what your opportunity set that you're monetizing can work. To a certain extent, otherwise you'll just be willy-nilly back and forth. You need to have a disciplined process. And to us, the first step to having a disciplined process, for example, is take a small slice of your savings and invest it in a broad-based index fund. That's what I tell people. Invest in a broad-based index fund. Now, most people who invest in a broad-based index fund underperform the index. And the reason we think it has nothing to do with fees or arguments, academic debates of active versus passive, or whether the markets are efficient or not. It's that when the investors in a passive index fund overtrade it. The whole point is you're supposed to invest in it, and that's it, forever. You don't start trying to, well, let's lighten up now, let's go in, let's go out. You do that, you end up just destroying, on average, your returns. So if you cannot invest in a passive index fund, even a small amount, trying to do all these other things aren't going to help, right? Investing in quants or option strategies or all these, it's not going to help. You're trying to avoid something that is just, you have to embrace a certain amount of risk. So our first sort of litmus test is, are you disciplined in what you're doing? And can you be disciplined in an index fund? And do you override your approach in an index fund? If you are good at that, which is relatively straightforward, then yes, focus on quant strategies, focus on alternatives, focus on all these other things that are available to you. We don't willy-nilly change, but we are cognizant of the changes that are going on in the world. And we actually assume when we price our options, when we price all the options, there's like 20 or 30,000 on the S&P alone. We assume that when we trade them, that we could be wrong. We could be wrong. We could be wrong in our assessments of the odds, and we could be wrong and the odds might change dramatically against us. And so that's part of our pricing and our risk management engine. And when we put that in, we say, if things are wrong, we need to stay in the game. And then we just continuously do that. Now, so we update, but we update in a very sort of disciplined manner and a focus on. But that's part of running a business, right? You have to sort of keep your finger on the pulse of the business, on the markets, and trying to understand what might be changing and to stay in front of it. Most of our updates have to do with technology. Just to give you a sort of sense, 30 years ago, we were still trading S&P 500 options. But back then, in order to successfully monetize the same edge that exists today, you had to be in the pits, right? You had to be in the pits, but to be in the pits, you had to be tall or loud or wear a bright colored jacket, kind of like in the movie Trading Places. So if today I told you, yes, we're doing the same thing, and you said, what's your edge? And I said, well, I have 6 big football players, you'd be like, well, that's ridiculous. That's not going to help you. So for us, everything is fairly computerized, automated, on the cloud. The trading desk has been automated, how much to buy, how much to sell, when to buy, when to sell, everything. It's the same edge over the decades, and yet the tools that are required to monetize it are totally different, if that makes sense. So a lot of the updates are sort of technology focused. Evolution. What do you think has the most edge today? What certain asset classes, certain strategies? I mean, you run a lot of different things. What if you had to, in a very simplistic, non-quanti way, what do you think is the biggest opportunity set today? Biggest edge?
I mean, I think it comes back to, I think there are 2 dimensions to that. One of the things that I mentioned earlier was that we consider alpha as really existing along 3 dimensions. You know, it's access to opportunities, it's the efficient execution of transactions, and it's market timing. I think we would probably agree that market timing is very difficult. And so the demonstration of particular edge with respect to market timing, the sustainability, the repeatability, you know, the judgment of whether or not that's luck or skill, I think it's tough, right? Efficiency, you know, you spoke a lot about you know, the automation of systems, and I think that there is certainly edge to be gained through infrastructure. I think probably the area which offers the greatest amount of scope for edge, although even this is eroding as information becomes increasingly ubiquitous, is access. You know, both of us primarily focus on public markets, but in private markets, maybe this is even more acute. The ability to source a deal that other people don't get a look at for whatever reason, you know, through Berkshire Hathaway or whatever the case may be, is a source of edge. And that type of edge is arguably, you know, where there can be the greatest scope for value add. Now, where I think we end up adding a lot of relative edge, and I think relative edge is probably, you know, ultimately in terms of performance, as important as anything else, is exactly along the dimensions that you were just speaking to, which is that a lot of people make decisions that are more emotionally driven or driven by a set of considerations, which is non-economic, at least non-economic in terms of not profit maximizing. And so, you know, the ability to introduce a process and focus which results in a profit maximizing set of decisions is an area where I think the bar in many instances can be quite low for improvement. And so, you know, there can be a lot of, it's probably edge used a little bit the wrong way, but edge in moving towards more of an efficient allocation for investors versus edge in the form of an alpha edge, which is along these 3 dimensions that I, you know, it's sort of less negative alpha as opposed to more positive alpha. But I think both are very important dimensions. So it's sort of, you know, the framework that we would apply to answering that question, and sort of thoughts on it. You?
Since we don't know, there's sort of a question that came in here about whether we think the VIX will spike or not spike, or whether there's a good opportunity in the VVIX or VIX. And the answer to that is we don't know. And so the problem with us with these VIX specific trades is someone comes in and they sell it at 30, and then it goes to 40, and they sell some more, and then it goes to 50, and they sell some more, and then it goes to 60 or 70, and they have to buy it all back. So I don't see, after the fact, we all look at that and go, oh yeah, sure, I would have sold VIX at 70, but you know, VIX at 70 it could have gone to 80 or 90 or 100. And so how much can you sell to begin with, even if you do think it's an opportunity set? To us, it looks like the natural sellers are out of the options market, that things are reasonably fairly priced at the 25 to 35 VIX level, and that there's tremendous opportunities right now on skew, downside puts, upside calls, which we are putting on. So that's where we think the biggest opportunity set is. And if you are long convexity bias, there's an opportunity to buy convexity. If you're a short convexity bias, there's an opportunity to sell it, or relative value, there's both. Another interesting question that came up here is, can you each compare where your mindset or strategy was in January, March, and April, May, or now? So we have limited time, so I thought maybe we'd both address that. What was your mindset or strategy in first part of the year, and then throughout February, March, and now?
It's a very good question. I think mindset and strategy are to some extent intentionally disconnected through process. So, I think to cut to the chase on this, I think from a positioning standpoint, as I mentioned, from a macro perspective, we saw the markets as fairly expansionary in January, contractionary in March, and sort of in a state of flux, sort of transitory being the predominant state in May. That has implications for the strategy mix that we see in our portfolio. So we don't see in our broad diversifying multi-strategy portfolios. We don't swing from one extreme to another, but I think what we saw was that certain strategies that we thought would provide diversification in January, we had much less expectation coming into late February, that those strategies would provide as much diversification, and there were certain types of risk that we ended up exiting over the course of sort of middle of February, and avoiding certain areas was probably just as important as having risk in certain areas that were profitable in terms of how things turned out over the course of the first half of the year. And May, we've reintroduced some of those sorts of risks as the environment has changed. I think in general, we typically see this transitory influx environment as being one of the more challenging ones to make money. I think we sort of tread the water with a slightly narrower set of strategies than January, but sort of a more normalization. Zem?
Well, mindset. Our mindset is, in order to be from January, February, March, April, and even now, we try to remove emotion from anything that we do. And one way of doing that, and the reason is that emotion tends to be a detractor and actually hindrance of performance. And so what we try to do is automate as much of the decision making as possible in advance. Kind of like being in the military, you need to automate, you have to train, and expect certain things to happen. And so from a positioning standpoint, our positioning was favorable coming in and was favorable during, and it seems to be favorable now. And the reason for that is that we try not to have any big opinions, and we certainly don't override it with our emotion. So our mindset was to try to stay calm in advance. We know that there'll be a storm. We don't know when the storm will happen. We don't know why it will happen. And we try to plan for that in advance. And we try to have favorable positioning at all times. And it seems to have worked out for us recently. I think moving forward across the spectrum, the opportunity set continues to be high. The risks also can potentially be high. And so, to repeat the mantra that we had mentioned earlier, sort of a closing to close the loop, in order to be successful at this is we think you need to be disciplined, stay focused, have a process. And if you do that, the odds can be massively stacked in your favor. Have the right timeline, have the right expectations about how long things can take and how long things can be mispriced or overpriced or underpriced. So I think that would be our mindset and strategy for the past and hopefully in the future. And with that, Mark, I think our time is fairly up.
Thank you so much for joining us today. I appreciate it, and thank you to everybody who participated and asked some wonderful questions. Good to see some coming in. All right. I'll be in touch with both of you soon, Zem and Yung-Shin. Thanks again. And yeah.
Thanks, everyone.
Thank
All
you.
right.
Thanks.
Bye.
Well.